Hello everybody. So, it seems like we may be getting a pivot based on everything that has happened over the past few days. And so I am so happy and excited to get back to talking about growth stocks. And hyper growth stocks, I've missed talking about them so much because this has been stressful. This whole banking system near collapse has been stressful for me. I'm so excited to be back into hyper growth stocks. So, as you know, part of my way to beat the denominator, or beat this monetary inflation, these ever-printing bailouts that we have left and right, is to invest in hyper-growth stocks. Invest in megatrends. It's a different type of investing, right? I don't look at things like PE. No, because I want to be out of the stock by the time it trades based on its PE, right? I look at price to sales. I look at price to growth. The whole goal of this strategy, right, is to enter in early before a product gets adopted and get out once it's obvious to everyone that the product is adopted, right? It's kind of like buying Apple in 2007, 2008 and selling Apple in 2020 or 2021. That is this 10-year strategy, this 10-year adoption trend that you're trying to pick up. And, this is great for me to get back to talk about this, because even though talking about macro was fun, when I look at the 2-year, it's clear to me that the 2-year may not be even pricing one rate hike coming up. When I look at the 2-year, I'm not even sure, right? It dropped almost a full percentage point in 3 days. So that's why a lot of the tech stocks were up today. There's a flight to safety, and safety in times of quantitative easing, safety in times of insane monetary printing is growth. That is my view, at least. And so today's stock, I have selected 9 stocks that I've covered on the channel. As you know, my portfolio is actually just about 30 stocks, but I just want to focus on 9 stocks today that I own, that I believe are in the early stages of these mega trends, these product adoption trends that are going to happen over the next 10 years. I believe all of the stocks I have are somewhere around here. They're different size, different sectors, big and small, but they're all early in this product adoption process. And right now, I'm just talking about my preferred stock within each megatrend. And so this is going to go fast, but just know that for each of the stock that I talk about today, I have a deep dive. Multiple deep dives on a lot of them. For example, the first stock, let me begin. The first stock that I'm talking about today is HIMS. Well, guess what? HIMS, I must have like 15 deep dives on HIMS. So I believe HIMS is very, very, very well positioned to capitalize on this growth on product adoption, right? So what is HIMS? HIMS is a preventative healthcare brand. It deals with minor recurring health needs and health issues, right? Like ED, hair loss, depression, birth control. HIMS has a lot of advantages. It operates fully outside of the insurance system, but even though you don't use your insurance when you go see HIMS, even though you don't, it's still cheaper than your copay. So still cheaper than your copays. And also noteworthy is the fact that a lot of insurance companies, they don't even cover things like ED or hair loss. So you may just want to use a preventative healthcare company and pay out of pocket, knowing that out of pocket, A, is going to be cheaper than your copay when your insurance covers, and B, your insurance may not even cover. One of the major selling points of HIMS is that while in the legacy system, to see a doctor, it may take up to 6 months, 9 months sometimes, because you have to get a primary care provider and then you have to get a referral. With HIMS, it's all digital. So it matches you with a provider in just 48 hours, right? Why do I think HIMS will be adopted? It's faster than health insurance. It's cheaper than health insurance. There's induced demand, i.e. there's people that don't want to jump through any of the hoops of traditional healthcare for minor issues that will jump through the low to no hoops that you have to jump through with HIMS. Lastly, HIMS has much, much better outcomes. It's a better brand with better product, right? A best example of outcomes is this is an example of some of the products that they have, right? This is for ED. You can see how a lot of people that need treatment are reluctant to take a pharmacy product, but they are redesigning pharmacy products, pills. They're redesigning them to make them more appealing to the customer. They're really taking this customer centricity approach. They take a customer centric approach to the adoption of healthcare. HIMSS gave us 3 years away guidance, right? They guided a $1.2 billion in revenue in 3 years away. So in this video right there, if you look at my channel, I calculate a 2.7x potential in 3 years, right? No investment advice, of course. HIMSS, I believe, should be valued like a SaaS company, right? They have 90% recurring revenue, 75% gross margin. These are all recurring minor health issues that people have to be treated for. They are moving into so many different segments. The stock is still cheaper than the IPO, despite having had outstanding earnings, and the growth has been stunning. The growth has been outstanding. This stock has been growing in the 80-ish% revenue growth rate for the past 2 years and a half. And so I believe this may continue to grow very fast for many, many years to come. I'm happy to be buying HIMSS right now. All right, what is another stock that I'm buying right now? Well, it is Nubank Holdings. So Nubank is a digital bank in Latin America. One of the reasons why I focus more on Nubank right now than, say, SoFi, even though I'm a shareholder of SoFi, is because I believe Nubank as an even greater value proposition in Latin America, because there's fewer competition from traditional banks. The U.S., what happened over the next few days is there's been a major bailout. They don't call it a bailout, but there's been a major help of traditional banks. Like the U.S., in the U.S., a company like SoFi, a digital bank, a neobank in the U.S. has to compete with legacy. With Latin America, they don't have to compete with legacy because most of the population they're going after is unbanked, and there is very, very little legacy. Look at the scale of Nubank. They have 75 million clients. They're engaging in cross-selling. They're very agile, introducing new products all the time and cross-selling all of these products to their 75 million plus customers. They are in 3 countries in Latin America right now, and they are expanding to many different countries. And why do I believe Nubank, a neobank like Nubank, will be adopted? Well, because I believe that fintechs are the better product. They are much better products than traditional banks for a lot of reasons. I've made a set of 2 videos about this, explaining why I think fintech is better. But the obvious one is, of course, cash is going away. So since cash is going away, you don't need that expensive branch infrastructure. It costs very little money for fintech to acquire customers, right? $5 to sign up, and boom, that's your customer acquisition cost. Gen Z, millennials, they much prefer apps for their banks because they want to have access to things like a modern user interface. They want an app. They want a chat box. They don't want to have to call a banker. They want access to crypto. They want better prices. This is something that only an app can provide. Apps are superior also because if you look at all of the issues that you've had in the banking sector, it's almost always due to human error. With an app, you don't have human error, and apps are much better suited to bank the unbanked, which is kind of a next wave of growth for banking out there, is really banking people who don't have a bank yet. And so I love Nubank. I believe Nubank has a lot of potential, and it's had explosive growth, outstanding growth, well above 50% year over year over at least the past 3 years. So very impressive. The third company that I'm looking at in an entirely different sector, right? I'm doing fully different sector today. I did HIMSS. HIMSS is healthcare. Nubank is banking in developing markets. Now I am doing Palantir. So Palantir, I am buying Palantir because it is the cheapest data operating system stock. If you've been following this channel for a while, you may know that I was very interested in Snowflake, and I like Snowflake. But Snowflake gave very disappointing guidance. And you may tell me, well, what is the problem? Well, Palantir also gave disappointing guidance. Well, yes, but Palantir is trading with a tremendous margin of safety, is trading at 9 times enterprise value to gross profit, right? Snow, with less margin of safety, is saving at 32 times enterprise value to gross profit. That's a huge ratio difference. Snowflake is much more expensive than Palantir, and also Palantir has a tremendous margin of safety in the business because of a military business and because of how much cash they have on the balance sheet, right? And, one of the main reasons why I own Palantir, I've said that in multiple videos, I have a full video about investing in Palantir for the military business. I believe that not only the cash position, but also the fact that they have the military business gives them a tremendous margin of safety if you're trying to invest in data apps, right? The goal is enterprise software, these data app software running the business, right? That's kind of a grand vision of a company like Snowflake or Palantir, is that eventually the business will be run by software and humans will just be here to build the software and the software runs the business. And I believe either Foundry or Snowflake are a little early on in that pursuit. But like I said, right now, to me, it's clear to me that Palantir right now is winning in the military business. I believe in the military business, if you look at how well they're doing, their Gotham software in the military business has already won. And I think one of the main reasons why I own Palantir, one of my main rationale for owning the stock is that military business. So talking specifically about the military business, about Gotham for Palantir, right? So why do I own Palantir, especially for Gotham? Well, first of all, Gotham has been the leading product for, say, anything from attacks, from wars. Gotham is known to has been instrumental in assisting militaries of the West. They have the most data out there, and if you have the most data, you're going to have the highest effectiveness in your assistant to the military and also the highest security clearance. So this is the company that has the highest security clearance than any software stock out there. And I believe the more I study Palantir's military business, I believe they have a very realistic shot at becoming the fourth leg of the U.S. military industrial complex. And if you follow this type of stocks, you know that these are tremendously sized stocks. Like Raytheon is more than $100 billion. All of these stocks, United Technologies, etc., they are very, very expensive stocks. So if Palantir has a shot at becoming the software leg of a military industrial complex, for me, that is a major reason to invest in the stock. That is a major margin of safety. Data is the future of warfare, and Palantir leads in that arena, and they don't have anything to prove in that arena. Foundry, they still have a lot to prove, and they still have a lot to prove as to whether they're going to be the data operating system of the future, but so does Snowflake. And therefore, this is what I say, Palantir in the military business, margin of safety, no competition. When I look at Snowflake, when I see the slowdown, the stock slowdown that they've had last quarter, they have had an insane slowdown. I'm like, Snowflake has a lot of competition, including major private companies that we as investors don't know as much about, like Databricks, right? Databricks is a major competitor of Snowflake, but they are private, so we don't have as much data on Databricks. So Snowflake is not exhibiting the stellar growth that it promised. Palantir is not either. However, Palantir is relative to its valuation. I believe that Palantir is exhibiting more than fair growth relative to the valuation. And Snowflake's growth is very, very, very disappointing relative to a valuation. They reported the worst Q4 and the stock barely moved. And so anyways, that's why I prefer Palantir. And that's my play in the data space right now. My favorite play in the data operating system right now is Palantir, even though I've been going back and forth. If you've been following my channel right now, I much prefer Palantir. All right, moving on. Another Latin America stocks. You may ask, I like a lot of Latin America stocks, but it's Square. So Square is, it's not Square, it's StoneCo, sorry, StoneCo. So StoneCo is the Square of Brazil. That's my best way to describe it. And I think for that level of revenue growth, it's as cheap as it gets. When I do my most undervalued spreadsheet videos, it is consistently ranked the cheapest along with HIMS. Their business is about 75% payment processing and 25% acting as kind of a Brazilian QuickBooks. And when you look at the valuation, they're trading at 2 times enterprise value to over trailing 12-month gross profits, which is ridiculously low. And their growth has resumed, and the growth is back in the 50%, but the stock has not resumed. The stock is still forgotten. So this is a stock that I think has been forgotten by the market. Warren Buffett owns it. Cathie Woods own it. The stock fell due to idiosyncratic reasons. They had a problem with their collateral registry in Brazil, which led them to lose a little more than $500 million because they had a collateral issue issue. They have solved the issue. They have replaced the CEO. They took the loss and they have moved on. But the stock is still derated. The stock is still left for dead. Even though that mistake that they've paid for, they've moved on. The stock is still down 90%, and I believe that mistake is behind them. But people have moved on, and that's when people move on. That's like, okay, this is getting very interesting. And I've been adding to StoneCo at these prices, right? This is a stock that's expected to keep growing at 50% a year, right? Payment processors are getting disrupted. Merchants are not getting these old bulky terminals from their banks anymore. They are not doing that. They are getting payment terminals like that offered by StoneCo. And this is part of a megatrend, which is the disruption of payments. So I made a whole video about the disruption of payments and why these technologies are getting adopted and what the payment processors behind Visa and MasterCard are getting adopted. And when you're making payment processing, more than 10 times cheaper than what it actually is with a bank, you're going to win. This is why in the US, you hardly go anywhere without seeing a small business with a Square Payments terminal. Well, for Brazil, the leading company in that space is StoneCo, and it is trading at a dirt cheap valuation, even though it has growth and it has remaining growth. All right, I am going fast. Let me move on to another sector yet again, Tesla. So Tesla is in what I call the energy independence megatrend. I think the best analogy for Tesla is it's the Apple of the 2020s. Now, do you know what Tesla does? And you'll see why I ask it like that, because it's funny. So I think Tesla is a conglomerate. Right? What do they do? So they have the biggest network of superchargers. They are the leading maker and installers of mega packs for utilities. They are an insurance business. They are an electric provider, just started in Texas, much long-term in Australia. They have a car repair network. They have a dealership network, right? Virtual dealership and showrooms, but they have that network. They have an AI as a service network with Dojo. They're very strong in AI. And whenever I hear someone tell me, oh, what does Musk or Tesla have anything to do with AI? Remember that ChatGPT, right, OpenAI product, who founded OpenAI? Elon Musk, as part of a PayPal Mafia conglomerate, founded OpenAI, right? They have a solar and Powerwall business. They're getting into the mining business. Right now, they have a robot program. Now, the robot program, Optimus, they call it, is mostly a ploy to hire engineers. I believe that that's going to help them attract engineers, because engineers think robots are cool, but that's nonetheless one of your divisions, right? So think of it as a Boston Dynamics nestled into there. Then they may have a robotaxi business, and they may have an HVAC business, and that is what they have just announced, and that's why I call it a conglomerate. But wait, I forgot to mention electric cars, didn't I? Oh yes, they also have electric cars, right? They have a luxury segment. They have a regular car segment, right, with the Model 3 and the Model Y, and they have a semi-truck segment, and they are about to have a truck segment, and they may even have in a year or two a compact segment, very likely. So they also make cars. So I think what's incredible is that I can spend 2 minutes describing all of the things that they do outside of cars, and then I just talk about cars. Isn't that crazy? That's why I'm saying, I'm like, this is a conglomerate of the energy revolution. This is an energy conglomerate, is the way I look at Tesla. Kind of a Standard Oil, like a modern Standard Oil, but for electricity, if you will. And so let's just go back to EVs. Will the product be adopted? Are EVs going to be adopted? Well, this is a story of 10x, right? Peter Thiel's book, right, From Zero to One, electric vehicles are our 0 to 1 story, perhaps the most pristine 0 to 1 story that we've ever seen. They're cheaper, faster, stronger, and better. Period. Period. If you look, so for example, look at the cost of electric cars, right? My calculation is they're 7 to 13 times cheaper to fuel, to charge, right? Depending on the state that you live in. And if you live in Europe, it's most likely going to be closer to 13 times cheaper. But for example, with the Tesla electric plans, Tesla released unlimited charging in Texas for $30 a month, unlimited charging in Texas. So assuming the use of a family, I calculated it's going to be 25 times cheaper to have a Model Y, for example, than to have a minivan or another SUV. So you're getting into a product that is well into the one order of magnitude cheaper to drive. But that's not it, right? They have very, very few moving parts. For example, the engine can be as much as 100 moving parts for a gas car. It's only 2 moving parts for an electric car, right? And an electric engine is a rotor and a stator. And that's it. There's very low maintenance. And because there's few moving parts and few maintenance, these cars last much longer than gas cars. And if you haven't heard that, I suggest you look up million mile. The million mile Tesla was kind of early days marketing of Tesla. Is, hey, Teslas last 1 million miles and they issued warranties on their Teslas for 1 million miles. Well, that's because there's very few moving parts. There's so much to say about Tesla. I don't have enough time to say that. Let me just address one of the bigger criticism, which is, charging doesn't work. Well, charging today, even though this is not mainstream information, but charging is essentially a non-issue nowadays. It's a non-issue because most people charge at home. Actually, 95% of the use of your car is going to be for charging at home. And of course, these Teslas have well above 300 miles of range. And so it's not a problem to charge at home, right, overnight. And so that's much cheaper. But that's also better than a gas station because a lot of crimes happen at gas station. A lot of women, for example, absolutely dislike going to a gas station because you have some people who think it's like a dating site or something. Anyways, I don't want to go on. So that's one of the reasons why it's a non-issue. It's actually a major selling point that you don't have to go to the gas station anymore, and it's cheaper. And also, if you're on a road trip, right, superchargers. Well, superchargers right now, they still take 25 to 30 minutes. But when you see what they've announced, like when you see the new products, like including the megawatt chargers with a coolant in it, it's very likely that within a few years or two, we're going to have 1 minute charging, and your cars are going to charge for about a minute because you're going to have a megawatt charger. So I believe the product is stronger, faster, better, cheaper. I could have said other things like it obviously accelerates faster than any gas car. Dollar for dollar, it's not even comparable, obviously. But there's other things that are going on for Tesla. So the leadership of Tesla has been pounding the table on that $20 million car goal. And when you compound what their production right now by 50%, you realize that it's achievable by the end of 2029 actually. And they keep guiding for 50%. I believe most of the reason why people can't see that coming right now is because we have as a species an inability to think exponentially. But when you look at what they do with the Model 2 and how they're going to manufacture the Model 2 when it finally comes out, I think it's easy to understand why while I think it's more likely than not that they will reach and exceed that goal. Last criticism of Tesla is, there's going to be competitors. Well, yes, there will be competitors for Tesla. I'm growing, especially after what happened yesterday. I am growing more and more confident that this whole raise of interest rate is just a bluff. It is just a bluff. And so we saw what happened to Silicon Valley Bank. They got bailed out. I am not foolish enough to not know that legacy auto, GM, for example, they will be bailed out. They will be bailed out. That's so obvious to me. But before they get bailed out, right, they're going to have to go through pain. All right, because you first have to go through the pain of the debt that they have, and they have so much debt. $200 billion of debt for each of the main US legacy players. And if you go to Toyota, it's even worse. And if you add the top 5 automakers, it's $1.1 trillion in debt. So even though I'm not foolish and I realize there will be bailouts, these bailouts will be after much much pain in the market, knowing that Tesla is undercutting them on price, creating cars that are ever cheaper. And you will also have the Chinese competition. And so, then it's all about the question is, how well are Chinese cars going to do? This is an unknown right now. This is an unknown. But that's okay, though, because the market is so large. It's kind of like the smartphone market, right? Apple has won and is number one in the smartphone market, but you still have room for Android, still room for that software and for other players and other makers, even though most of the profits, right, flow to Apple. That's why Apple is the largest company in the world, because most of the profits flow to Apple, because Apple was the disruptor. And I believe we're gonna end up in a world where cars are gonna be the same way, where Teslas are gonna be the mode, right? They're gonna be the most common car, and most of the profits will flow to them, and they will lead the industry. And I believe the other automakers will struggle to make a profit, which is exactly what we see in the current smartphone market. That's why a lot of people say, and I say, cars are iPhones on wheels or smartphone on wheels. That is what they are. So I'm moving out from this. I've done a lot of videos on Tesla, but you know that there is a lot of content out there on Tesla. So I don't cover it too much, but it is still a big position for me. It's actually my number one position. Okay, moving on. MercadoLibre. I love MercadoLibre. MercadoLibre, you see a theme, right? Nubank, StoneCo, MercadoLibre. MercadoLibre is the Amazon of Latin America. They've had stellar revenue growth for a long while now. And it shows no sign of a slowdown. Their full year 2022 over 2021 was 56% constant currency revenue growth, 56%. So that is some major revenue growth. They are an all-in-one business. So they have e-commerce, they have logistics, right? Kind of equivalent of Amazon Prime, and they call it Mercado Envios. They have their fintech with Mercado Pago, noting that the Mercado Pago, their fintech business, right? So they are a competitor of Nubank in this. Their fintech business has 5x in 3 years. And frankly, when I look at the valuation, it's like I'm getting the fintech business for free. So the fintech business is doing well. They have an exciting advertising business that they're getting started with, and the company keeps firing on all cylinders and is really winning. I did a full video on MercadoLibre explaining my expectations. You see, I spent 18 minutes here talking about MercadoLibre and everything I see for that stock. But why will MercadoLibre win? Why will the product be adopted, I believe, and go through that adoption curve, that S curve? Well, because e-commerce is a major trend around the world, but it's a major trend in Latin America too. Except I believe there's been a delay in adoption of e-commerce in Latin America. Like right now, they are in the boom of 2017, 2018 that we had in the US. If you remember that boom, they're going through that boom right now, and so I believe this is a company that has a lot of further room to grow. Knowing that their forward revenue growth is expected to be 45%, and their gross profit is 49%. So for e-commerce, that's actually very high, right? That's not going to be a software stock or a HIM stock type of gross margin, but that's going to be very high. And as you noticed in this video, I'm going through stocks that have nothing to do with each other, right? So this is data, this is banking, this is healthcare. I'm trying to show you a diversified portfolio. So that's why I'm going from MercadoLibre. In the spirit of a fully diversified portfolio, let me move to another stock in this portfolio, which is figs. So I own just a little bit of figs. I just started accumulated figs. Figs is an entirely different megatrend. Figs is a play on a lifestyle stock. What is a lifestyle stock? Well, that is a stock that tries to focus a narrow segment of consumers and try to sell a lifestyle and image, kind of all of the hallmarks of branding and marketing. And I believe figs is kind of a gem. Actually, Ron Barron, who's a very early investor in Tesla, put $100 million in figs, and figs is very cheap right now for their potential, I believe. So one of the common comparison of figs is Lululemon. Is figs the next Lululemon? And when you dig deep into figs, you realize that there's a lot of of similarities between both companies, except Lululemon tried to go after the yoga sportswear market and disrupt that. Figs is going after the scrubs market and disrupting that, and using kind of the whole clothing playbook to disrupt that market. They want to create a new brand that resonates with the consumer, but that starts with scrubs and the idea that these need to be disrupted, just like at one point workout pants needed to be disrupted. And this is based on a lifestyle talk, so the whole idea is old brands, right? What do old brands mean to people anymore? Brands like Gap, for example, they're dying along with physical retail. Like, what if I tell you Kohl's Apartment 9 brand? What does that mean to anybody anymore? It doesn't mean much, because these old retail stocks are slowly dying, right? And they're getting replaced by internet first brands, right? And so Figs is that. Figs is a new brand that is internet first. And I think it has a shot at being adopted, And why do I think it will be adopted? Well, first of all, they've seen a slowdown in their growth, but I believe that's likely due to tough comps that they have in healthcare from the high demand, especially in 2021. They have no international operations whatsoever. They're just getting started with international. I believe they're using a proven, tried and true playbook, which is you take something that is unattractive, like scrubs, like baggy scrubs, and you're making it stylish, you're making it more attractive. This is like a classic playbook in clothing that has worked for well over 100 years with style. And so a lot of people who are more fashion forward, they will be attracted to a product like Figs. And I also believe that they have a major tailwind is that in that there's many bankruptcies in the clothing sector, right? Go to any mall and see all of these department stores, but also a lot of these traditional mall brands where people used to buy their clothes. They're struggling, and many of them are closing. And I think also one of the major advantages that Figs has, say, compared to any other type of clothing, is the fact that because they're first focusing on scrubs, right? Eventually, I believe the major portion of buyers of Figs eventually will have nothing to do with healthcare. Just like today, the majority of people who buy Lululemon today have nothing to do with yoga, right? But when you get started, when Lululemon got started, it was all about yoga. Figs is a company that is getting started, and it's all about healthcare. It's still a majority of their business. One of the main advantages to have a margin of safety of scrubs as kind of your base business, kind of your core business being scrubs, is that healthcare professionals have to change these all the time, right? They wear them for 10 hours a day, so they have to change these all the time. So you have kind of a built-in recurring revenue in there as well. So I think Figs is an interesting company, and I especially like that it is not correlated with any other stocks that I have. I think the correlation is very, very low, long-term correlation. That is not short-term, right? I mean, the crash of Friday, everything was correlated. Anyways, moving on to another sector. Another sector that has nothing to do with all of the other ones I talk about today is cybersecurity. So cybersecurity is the future, right? Cybersecurity threats don't fall asleep. There's threats all the time, and hackers are getting more and more sophisticated. And I believe the best cybersecurity stock right now is Crowdstrike. Crowdstrike focuses in endpoint security, and endpoint security is protecting terminals, like protecting laptops, right? It's user based, like you're going to protect your laptop, having set up on a laptop, for example. I've been following CrowdStrike for a long while. Listen on the call, they're taking on Microsoft. And they're actually making headway in competing against Microsoft, stealing market share from Microsoft and their endpoint security product. I think the product has a lot of promise. For example, they're going after small and medium-sized businesses because they are going to include CrowdStrike in the Dell laptops. So all of the Dell computer, desktop, and laptops, they do mostly laptop these days. Most of these computers are going to have CrowdStrike pre-installed, and so the CEO was very, very positive about this. Cybersecurity is a major imperative. This is, I believe, a very, very solid company. Growth has been in the 50% for at least the past 3 years. I believe it will continue. They gave us outstanding recurring revenue guidance for 3 years from now. And so I did a whole video about this where you can somehow deduce a potential return of 2.5x in 3 years. So 2.5x is really, really good. 96% recurring revenue. The rest is a little bit of consulting. 94% gross margin. This is amazing. They have a classic moat within their distributed threat graph, what they call. And the funny way that I have is you collect data from the crowd and then you strike. So Crowdstrike, the name is very, very clear, is they have a network of tons of computers, right, that collect data. And if you have all of these computers that collect data, you get the best data. And if you have the best data, you can train the best AI that is going to strike the threat. Right? So it's kind of a snowball that you can't stop, which is the chart I have here. The more customers you get, the more data you get, the better cybersecurity software you get, which in turn, because you have the better cybersecurity software you get more customers, more data, better software, more customers, more data, better software. This is, I believe, one of the most compelling flywheel. It has very few links in that flywheel. Very straightforward business model, and I clearly believe they are doing well. They are doing great. The call is so positive. The call was so positive. The latest one. Love Crowdstrike. Entirely different from all of the stocks in this video. And then the last stock, and I'm gonna take a risk here and talk again about Opendoor. Now that we have a Fed pivot, it seems, we'll see, but now there's probably a pivot. I mean, there's been a major bailout, in my view. So let me just talk about Opendoor. You may know that I've owned Opendoor for a long while. I've been a customer. I've sold a house with Opendoor, bought a house with Opendoor. I just love Opendoor. But Opendoor is a tier 3 stock. So every investment that I do is all about risk management, right? My videos from a few days ago, I was telling you, having money at a bank is fine. You just got to be compensated for counterparty risk. I feel kind of the same way with stocks. It's like having any stock is fine. You just need to be compensated for that risk, which is why I only have 0.8% of my portfolio in Opendoor. I actually added more to Opendoor on Friday, just a little bit, because even though it's a speculative play, and I am really a contrarian on this one because every single person would be willing to bet their house that this company is going bankrupt. And they may be right, but I believe I have tremendous upside potential right now at a company that is worth only $1 billion. And the total addressable market for me, for a stock like Opendoor, is so huge because we're talking about real estate. It's a platform, right? A lot of businesses are becoming platforms. If you compare, for example, Airbnb versus hotels and short-term rentals, right? That's a major platform, right? Fiverr versus temp agencies, that's a major platform. The world is headed towards platform, and this is a platform that is going after those fees. The fees have not changed from, more than 100 years. Today, what are the fees, right? If you sell a house, you're going to have 6% fees that you're going to pay with a realtor. The problem is, if you've sold a house or if you've bought a house, you probably know that most of the work today is done by the consumer, right? I mean, sure, in certain markets, I'm sure there's a realtor who actively drives you around town to show you houses. But I've bought a few houses, and I can tell you every single time it's me going on Zillow, contacting someone on Zillow asking to see the house. And so you got to ask yourself, because we have all of these platforms now, do you really have a need for the 6% fee, right? And the answer to that is no, because that's just rent seeking. It's like if you want to have access to the MLS, you got to go through a realtor. That's rent seeking, and rent seeking, i.e. traditional moats, right? We're getting disrupted left and right. And so, could the Fed still kill Opendoor? Maybe, but I haven't sold my stock, and I don't, I still wouldn't make that bet. I think the market is taking this stock for dead, and I don't think it's dead. So will the product be adopted? Well, we'll see about that. But what is Opendoor, right? It's a platform. It's a liquidity provider for real estate. You sell a house to the Opendoor platform by clicking on a button. You buy a house from the Opendoor platform by clicking on a button. They have the best app. It's fully automated. The real estate agents that help you within the transaction, and all of the legal proceedings do not help you during that 1% of the search, right? So the fee that each real estate agent takes, partner agents of Opendoor, is 2%. They're agents who, for the most part, exclusively work with Opendoor. And so if you have two agents that earn 2%, it's 2% and 2%, you're going to get down to a 4% selling fees as opposed to a 6% fee. And so imagine how much money, how much savings that is. That is tremendous amount of savings. That's why I believe a lot of people don't get Opendoor. Opendoor is not a home flipper. If you're not buying a house and selling it high and riding the rise in the stock market, no, they're a liquidity provider. Think of it like a NASDAQ for real estate. I believe this platform aims to disrupt the MLS by cutting the fees. You disrupt. That's what you do in general, right? You disrupt by cutting fees. When you arrive in a market, you provide a better product, a better solution when you cut fees. And there's so much going on with technologies as to why Opendoor is actually a better solution, and you cut the fees. And so, if you imagine that they're just successful, like if you envision a future where Opendoor is just a bit successful, forgetting the fact that platforms tend to be winner-take-all markets. I really want to emphasize that. Platforms are typically winner-take-all markets. Airbnb is the number one platform, right? What is it? Match Group for dating is the number one platform. There is no second best. I could go on, but these platforms, when a platform is the first, it usually takes the whole market share. So me to assume a 20% market share seems crazy right now, but I don't think it's that crazy actually. And in fact, during 2021, they got to that level in a lot of markets. And just calculating from 20%, feel free to pause, I'm getting at a $286 billion market cap, which is ridiculous, which is crazy. And, I realize I'm a contrarian on this stock, but, I have proper risk management, which allows me to be a contrarian. I've done so many videos on Opendoor. I've done like 20 videos on Opendoor, so feel free to watch them if you think this company is interesting. But I think this company is an interesting one, and I'm fine losing the 0.8% of a portfolio if it does not work out, right? That's a good day on Tesla stock. So anyways, this was it. This is the 9 stocks that I think are well suited for a Fed pivot. The 9 stocks that I think will do well with a Fed pivot. This is not advice. This is not investment advice, legal advice, not advice of any type. This is just entertainment, edutainment. Appreciate all of your like. Thank you if you subscribe. Thank you, and have a wonderful day. Goodbye.